Hey everyone, this is Matt with the Fundamental Investing Institute. Thank you for tuning in. Today's video, we're going to talk about another financial concept that we see in the SMB acquisition world. Now, as a reminder, SMB stands for small to medium-sized businesses, and we're talking about the acquisitions of these smaller mainstream businesses, and they're really, these type of acquisitions are available to anyone with some business knowledge and some operating experience. So in a previous video, we talked about SDE, which stands for seller discretionary earnings, and it's really kind of the total owner benefit that that business is kicking to whoever the owner operator. And one of the flaws of that measure, probably the major flaw of that measure, is that it is ignoring the cost of involvement of a working owner. So we've got another measure that we often use, we often hear about, and that is, it's an acronym. It's EBITDA. It's often pronounced EBITDA, and it stands for earnings before interest, taxes, depreciation, and amortization. Now, I sometimes hear that term used interchangeably with SDE. That's really a mistake. The way that you want to use this measure is to make sure that it is net of the cost of owner involvement. So we have to make sure that we are taking into account a reasonable salary and reasonable benefits for a working owner, or if we had an operating partner, sometimes is the case where people buy businesses, they instill someone to run day-to-day operations. We want to make sure that we're provisioning for that. So what it is it is a proxy for the operating cash flow. It's a very flawed proxy, and the major reason why it's a very flawed proxy is that by adding back non-cash expenses, particularly depreciation and amortization, we're really ignoring cost of reinvestments that have to go into the business. Now, I don't like using depreciation in our measure of cash flow. I will talk about how we think about cash flow in a subsequent video, but for the moment, I should say that absent some kind of provision for expenditures that you have to make into the company to replace tangible assets that are going to break. I mean, if you have a vehicle, it's not going to last forever, for example. If you ignore those costs, then you really have a very flawed measure of cash flow. But it is a term that gets thrown out, so we wanted to familiarize everybody with it. And really the definition is in the term itself. You know, you're taking earnings, you're adding back any taxes, which usually in the small business world, we're working with pre-tax numbers anyway, so that doesn't come in. But then we're making sure that the financing costs get added back, and then we're adding back those non-cash expenses, namely depreciation and any amortization. So we'll talk more. Again, we're working our way up to a more useful definition of cash flow, but for the moment, I wanted to introduce that term that we hear a lot. Thank you for tuning in, and we'll talk more next time.